Once you start thinking like an investor, this is where we move on to number 4, which is now you build your game plan. You build your strategy of how you're actually going to invest your money. And there's 2 general game plans that I like to talk about. One is a passive strategy, one is an active strategy, and you can figure out which one of these or both that you want to choose. Me personally, I do a little bit of both. So let's talk about both of these, starting with a passive strategy, because this passive system is what I believe most of America, 90 to 98% of America should be doing to build wealth, because this active strategy takes a lot more work and a lot more financial education that I don't think most people are actually interested in doing. But if that's something you want to do, that's fine. I just want you to understand how both of these strategies work. So the passive strategy, the way that it works is it is an automatic system where every time you get paid, maybe it's every week, maybe it's every 2 weeks, maybe it's every month, you're gonna have cash be pulled out of your checking account, and it's gonna be automatically invested into your portfolio of funds. This might be ETFs, this might be mutual funds, this might be index funds. And what these funds are is they are groups of stocks, because you don't want to be investing in individual companies like this, because when you invest in individual companies with a passive strategy, you're taking on all the risk. So let me give you a little example of this. A couple of decades ago, some of the strongest companies on our stock market and in our economy were companies like Bed Bath & Beyond and Sears. And a couple of decades ago, every financial advisor would have told you that these are strong companies, they're strong innovators, they're category killers, and they're going to be strong investments. Well, if you created a system where your money is consistently going into these companies because now you want these companies to fund your retirement, today you would have nothing. And so this is where now you want to protect yourself against these bankrupt companies if you're going to be a passive investor, by investing in something like a fund. And what a fund is now, instead of investing in just one company, you're going to invest in hundreds of companies or thousands of companies, depending on what the fund is. That way now you're protected. If one of the companies in this fund goes bankrupt, well, you have dozens or hundreds or maybe even thousands of other companies to protect you. So what these funds do is they lower some of the risk. Now, of course, they do lower some of the upside as well, because if you invested your money in Amazon when it was a penny stock, well, you'd be extremely rich today. But that means you have to actually find that Amazon, make that investment and hold on to it, which most people aren't willing to do. So with these types of funds, the index funds, ETFs and mutual funds, you have the opportunity now to lower some of the risk, and it does limit some of the upside, but you have the ability now to create this type of passive investment where money can automatically be invested into your portfolio of funds. And now you just let the markets do their thing, because now you're investing into the market. Now, for example, I'm not telling you what to invest in, just giving you an example. There are funds that give you exposure to the total stock market, like VTI. This is an ETF, meaning it's a fund that if you bought one share of this fund, VTI, you'll buy a little bit of every stock on the American stock market. That's what VTI is. There are funds that give you exposure to the S&P 500, like SPY. SPY is an ETF that if you buy one share of SPY, you're buying a piece of the S&P 500, which is a group of the largest 500 companies in our stock market. There are funds like DIA, which give you exposure to the Dow Jones. The Dow Jones is a group of 30 selected companies in our stock market. You might have heard of people talking about the Dow Jones before. And there are funds like QQQ that give you exposure to the NASDAQ. The NASDAQ 100 is a group of the 100 largest companies that are not financial, that are listed on the NASDAQ. So now, instead of you going out and investing in one company, you can invest in funds such as these. Again, I'm not telling you what to invest in, but there are so many funds out there. There are funds that can get you dividends. There are funds that can give you exposure to the stock market. There are funds that can give you exposure to technology or healthcare or emerging markets or innovation. You just got to figure out what it is that you want to invest in. And then you build this portfolio of funds that you want to invest in. You figure out what types of funds that you want to invest in. You list them out here, and then you see how much of every dollar invested you want invested in every fund. Like, for example, if you were to invest in these 4 funds, do you want it to be 25 cents, 25 cents, 25 cents, 25 cents? Or is it 50 cents, 10 cents, 10 cents, 30 cents? You just figure out how you want your money to be invested, and then you turn on the system, you automate it, and then you don't worry about it. This is where now you don't want to change things when markets go down, except maybe you invest a little bit more aggressively because you understand that market crashes happen and they create opportunities for you to continue buying good investments. The only time you'd really change this is if the fund that you're investing in, the industry that you're investing in, the thing that you're investing in, something is really wrong with that. Now, of course, investing has risks. You're never guaranteed to make money invest. You might even lose money. In fact, you will lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But this is a strategy strategy that has the potential to make you wealthy over the long term if you stay consistent with the strategy, the way that I do this. Again, I don't recommend what I do to anybody else, as I have a system where every Wednesday, cash leaves my checkings account and it's invested into my portfolio of ETFs. Now, the largest piece of my portfolio are dividend-paying funds because I like to generate cash flow. So now I'm investing my money into my cash flow. Every time I buy more cash flow, my cash flow is buying me more cash flow. I also invest in funds that give me exposure to value stocks. I also invest in funds that give me exposure to innovation stocks. I also invest in funds that give me exposure to emerging market stocks. So this is where now you got to kind of figure out what's right for you. Now, if you're watching this and you're wondering how you can find a software or a way to automate these types of investments, there are a ton of different types of softwares out there. Just go to Google, find the right platform for you. I personally use a platform called M1, who is also a sponsor of the Minority Mindset and the sponsor of today's video. So if you want to invest your money passively into the stock market, the reason why I like M1 is because the way that M1 works is, number one, it's free to use, but then you can go and create something called a pie. A pie is your portfolio of different types of funds or stocks that you want to invest in. So now you decide what different types of funds you want to invest in, and then you decide how often you want to invest your money into these funds, every week, every 2 weeks, every month, and then you turn on your system, you automate it, and then you just kind of forget about it. You let the investments do their thing. Now, of course, investing has risks, but this is a way for you to passively invest your money without having to spend a ton of time doing that. So if you'd like to learn more about M1, see how you can passively invest your money, I got the link to how you can do that and learn more down in the description below. Minority Mindset is a paid partner with M1, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you'd like to learn more, I got the link for you down in the description below, or you can go to theminoritymindset.com/M1. That's theminoritymindset.com/M and the number 1. The way active investing works is now you are going to take money. So now this is money that's going to be sitting in your account somewhere, maybe your bank account somewhere, maybe a high interest savings account somewhere. You have this cash, and now you're going to be looking for a good investment opportunity, maybe an undervalued stock. You're looking for some sort of good investment that you believe is going to give you long-term potential. And now you're going to be waiting until you find this stock to invest in. And when you find a good time, that good opportunity, that good price, that's when you're going to go in and buy. But the reason why this takes more work, more financial education, and more patience is because now, number one, you have to know, how do you identify a good stock to actually invest in? And this is going to require you to invest in your own financial education to understand companies. And the first thing you want to understand now is, how do you read financial statements? How do you read a cash flow statement? How do you read a balance sheet? And how do you read an income statement? This does take time and it takes work. What you want to understand is that a cash flow statement shows you how the cash moved through the company. An income statement shows you the profit and loss of a company. This way now you can see, are the profits growing or are they shrinking? Why are the profits shrinking if they're shrinking? If the profits are growing, is it sustainable what they're doing? And then the balance sheet shows you the assets minus liabilities of the company. And this is where you want to take a look at, are the liabilities feasible? Are the liabilities too much for a company this size? Is this a good and healthy run company? Then in addition to that, you want to look at the executives of the company. You want to look at the company structure. You want to look at how they're innovating. You want to look at the general pulse of, do people actually like these products? And will they want these products in the future? And how is this company going to stay competitive in 5 years and 10 years from now? So you can start to see how this financial education takes much more work, which is why I don't recommend everybody do this. In fact, I don't recommend most people do this. But in addition to that, you also have to have the right psychology as an investor, because now on the psychology side, you don't want to come in and buy when the stock is overvalued just because you hear everybody else talking about it. You also don't want to go in and sell at the wrong time because everybody's panicking and freaking out. And so you have to know how to manage the psychology of investing with the financial education and understand that this comes with more risk. More risk comes with more potential gain, but it also comes with more risk. And so now you have to understand, if you're going to be following the strategy, if you're going to be investing in individual companies, that's completely fine. But understand the risk, understand the strategy, and also understand your goals. Because now if you just go in and throw your money into something that you think is the next Tesla or the next Amazon or the next Meta, but you really have no strategy or goals because you're just throwing your money in because you hear people talking about it, well, how do you know what to sell? How do you know how long you should hold it? How do you know if something's so wrong with the company that you shouldn't keep owning it anymore? And how do you know what you should actually do with the stock if it starts paying you dividends? Now, I'm going to say this one more time. You don't have to pick just this one or just this one. You can kind of do a hybrid, but you have to understand the risks associated with each one of these and understand what your strategy is before you start investing your money. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.